Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
Let's go out there. It's July 19th. I'm Frank Curzio. It's Wall Street Unplugged. So I bring the headlines and tell you what's really moving these markets. So back from a mini vacation. Go away every year with closest friends. Usually go to a racetrack to bet the horses. Also go golfing for a few days. And sometimes we go to Gulfstream for the Florida Derby, which is in March. And sometimes we'll wait a few months, depending where we want to go. And the last 3 years, we happened to go to Saratoga opening day. And last year, if you listen to this podcast, I killed it. I won $3,500. It was awesome. So you know what's going to happen this year? I was going to get crushed. And this year, I actually won around $4,000, which means I'm officially retiring. I'm out of here. I'm a horse handicapper full time. Go to the races. They sell those sheets, different colors and blue and red. And I got the picks. It's going to be me in one of those booths. I think you guys should be pretty cool with that, considering you really don't need me anymore. I mean, everything is going up every single day. I mean, how crazy is this? Just by Carvana, which is up, another 30% today? Up over 1,000% this year. And I know that stock was 100 to 200 and crashed to single digits. Holy cow. This year. And more on that in a second. But Saratoga is always a lot of fun. If you get a chance to go to tracks, great family atmosphere. I posted a couple of things on my Twitter account at Frank Curzio. It's just cool. You can bring your family. It's all outdoors. Most of it's outdoors. I used to take me there all the time in the 80s. I learned how to handicap horses when I was probably, 10, 11, 12. My dad used to take me to every Roosevelt racetrack, Long Island. I used to be around. Monticello, in the middle of nowhere, used to go to. But he used to get tickets, grandstand tickets, for Saratoga in the 80s. And it was only open through August. Used to rotate with Belmont and Aqueduct. And now it's open, I think, more than that, 6 to 8 weeks. We went there, last week. But he used to take me to the springs where the water is terrible. It's like this water fountain where you drink the spring water. Kind of a big deal, like a landmark thing. It's been there for over 100 years. And I went to do that and brought back, just memories. And the friends I went with, all of them since I was a kid, so I all knew my dad. And one of them I know since I was 3 years old. And we lived across the street from each other in Ridgewood, Queens. And used to throw baseball back and forth because we weren't allowed to cross the street. That's how long I know this person for. So, we go there. We have fun, golfing, just a really good time. My wives know each other and everything. They're like, happy that they just get out of here. We want you guys to go so you can leave us alone. So it's really cool that we do it every year. But after the races, Saratoga has a pretty decent nightlife. Lots of bars and restaurants. We went out to eat one night. I think it was a Friday night. But almost all the bars are like in a 5-block radius, and it's pretty crowded, but they cater to the super young crowd. It's not like you have a spot where you can go and grab a beer. It's all really super young, like music blasting, and when I say young, 25, 30. I can't believe that, right? I'm saying that. That's how old I am now. But after we ate dinner, one of my friends was like, hey, Leo, let's walk around, just see what's going on, and you like seeing that stuff sometimes, and people having fun. And most of these bars are right next to each other. And, you literally see hundreds of kids walking through the streets. And some are drunk, having fun or whatever. But we happen to stick out like a sore thumb, just walking around. And we didn't go into any bars, right? We had no interest. We just wanted to, walk off, our food and stuff like that. But just walking around, I felt like a dinosaur. And just to confirm my state of mind here, how do I officially know that I'm getting old? As we're walking, some young guy driving down the street, he slows down, opens his window, and said, hey, old guys, you need to take a shower. Closes his window and drives off. Of course, I yelled something back, which I can't say. But, man, if that's not the ultimate confirmation, and he's kind of right. Probably better off just hopping in an Uber, going back to our place, and maybe taking a shower. But I think that was the ultimate confirmation where, wow, we are old now, over 50. And it shows. So even when you want to have fun amongst those people and walk around and just see what they're doing. Man, they saw us right away, call us out, which was funny. And it was a good time. So anyway, really, really great times meeting up with my friends. Feel refreshed. I think everybody needs that just to get away a little bit. Now, back in the saddle, ready to help all of you become better investors. This is why you guys listen to this podcast, I think. Try to make it as entertaining as possible, not boring and buy this stock, trades, 10 PE. No. Try to make it a little interesting. Like I said earlier, I'm not too sure if you need me. Just buy whatever you want. And we've seen a market where the AT&Ts and Verizon should have been good names going into this year, given that, hey, we're probably going to see a recession. Rates are going much, much higher than expected, which we were able to predict. Earnings are going down and they're crashing. And this is an area where you see multiples fall. When I say multiples, the P ratio, the P multiples, could usually contract. You don't see them expand, especially when the economy is expected to slow, interest rates going higher, Fed now taking money out of the market. You don't see these multiples expand ever in history during markets like this. They always contract, and now you have these companies generating good cash flow, decent businesses, and what happens is when you have a risk-on environment, everyone's like, F you with these names, I don't need them. And now you have a lot of things going on in media and stuff like that and craziness, but wow, what a market this is. It's insane. I mean, everything now. You're looking at oil and industrials were underperforming. Now they're doing great, right? It's starting to bounce back. Industrial, some of them are trading at 52-week highs. Again, these are lagging behind a lot of large cap tech. Almost every heavily shorted company has skyrocketed. I mean, hedge funds were short Carvana at $5 a share. That's to start the year. It was under $5. It's over 50 right now. It's over 50. So in January, to start the year, it's 4 and change. The short ratio is over 50%. That's a monster number if you don't understand short ratios. It's just how much of the float is short. You have to borrow. And if you see a 10% ratio, it should raise eyebrows. 20% is high. Someone's taking a big position. Maybe you're going to see them do the campaign where they come out with, a bullshit report. Some of these short sellers are good, and then they'll go through their typical media channels. And before they even get the report out, there's lawyers following suits like ambulance chasers this way. It looks like, holy shit, and sells off, and these guys are out of that stock and whatever. So you could see that build up sometimes. It's not that hard. It's not that easy to hide. So you see 10, 15% rates. 50% is insane. 40% is insane. So in June, the stock started ramping higher, and it went to over 20, slowly going high, went over 20. And even at over 20, still 45% of the float was short. And a month later, it's 50. Now, Carvana, just to put this in perspective, right? Back in January, $400 million market cap, stock crashed completely. And you might be saying, these guys are idiots for shorting. They're not idiots for shorting. A $400 million market cap, you could see why so many was short. Because today the stock is up, 25, 30%. Why? Because they restructured their debt. And that restructuring included unsecured notes due in 2025 and 2027. I won't get complicated with you. Just understand, when they were able to restructure this, it's going to save the company over $400 million in interest expenses per year over the next 2 years alone. Remember, in January, the market cap was $400 million. Think about these payments. I mean, they're saying it's going to save them over $1 billion, by restructuring this. Just the $400 million in interest expenses over the next 2 years alone. And that's after restructuring. You could see why they thought this company was going to fold, and they were done. Now, up 1,000% this year, $4 billion plus market cap. Short ratio has gone down, but still, it's around 35%. I don't know who's short this thing, but man, they're getting crushed probably. I would think. And it's not just Carvana. The Dow's up 8 straight days. Longest winning streak in over 2 years. And by the way, the Dow, that performance of that index, it sucks this year. Sucks. It's only up 6%. 6% for the half year, 7 months in, would be fantastic in any other year possible, except for this year. That sucks. Why? Because the S&P is up 18%. The NASDAQ is up 38% this year. 38% this year. Think about that. You think large cap tech's overowned? And I can tell you, with the Fed saying, well, we're going to raise rates, that might be a sign. Daniel, I'll talk about that in Street Unplugged Premium tomorrow. I think the more they say they're going to raise rates, the higher this market's going to go, at least through the end of the year. Different from what I've been saying. Why? Because when you stop lowering rates, or you stop raising rates and you start lowering, it's a signal saying that the economy is losing steam and it's not that strong anymore. And we've seen recent data showing inflation is cooling, still have a long way to go. And we'll see, because energy prices are up tremendously. Food prices are going back up. We'll see what the next CPI rating is. So housing starts calm a little bit, retail sales down a little bit. I mean, things you want to see. Careful what you wish for, though, because when the Fed stops this, if you look at the last past tightening cycles, the market usually goes up as they're tightening. And I'm looking at past tightening cycles of this magnitude, nothing's as this big of a magnitude. Raising rates over 2,000% in a little over a year, 15 months or so. Never seen it this fast in the Fed era, but comparable times, 2-3 other times, we've seen it where the market has gone up, and as soon as they start cutting, we're under this impression, wow, that's the bullish thesis, by the way, in January. The bullish thesis was like, the Fed is not going to raise that much. They're going to start cutting pretty much by June, and that's why you need to own stocks. It's amazing. But it's better to be wrong in your thesis and right on the stock price because you're going to make money. Because what happened is the Fed was not done. They're not going to be done this year, and chances are they're not going to lower into next year, well into next year. Unless you see the economy ultimately crash or really go into deep recession. But they're not lowering rates anytime soon. And in that environment, we've seen stocks absolutely surge. So much so that the S&P 500, think about this. It's trading at a higher level right now than it was in March 2022 when the Fed started raising rates. You will not find one person on the planet that would have took that bet if you said in March, the Fed is going to raise rates to above 5% in 15 months, but yet the S&P 500 is going to be higher by then. There's not one person in the world that would have took that bet. They might have said, well, it might not go down, and maybe individual stocks could outperform depending, who's interest rate sensitive and not. They wouldn't have said the whole market's going to. Nobody would have. Nobody. Not from 0 to 5%, 0.25 to 5%. Nobody would have. You would have been crazy. That's how insane this market is. Because the Fed says, hey, we're still going to raise. That, to me, that's the market saying, okay, they're all clear. The economy's good. We can handle this. Pedal to the metal. Fear of missing out. Still a little bit of money in the sidelines, even though some of it's going to bonds and getting 5% rates, which is fine. But the Nasdaq up 38%. The S&P 500 up 18%. Again, the Dow has been underperforming. But now, what do you have? The Russell, and it's going to say it's up 12% year to date. But forget about year to date, because it's up 14% over 14% since May. Since we've been pounding the table like crazy on this sector. And I'm glad. Because everyone took us up on our offer. We've been killing it in our Curzio venture portfolio. I expect this to continue. It's not like, oh, wow, this is great. Let's take some profits. No. And we've seen so many amazing companies, big disconnects where smaller names already cut costs, starting to see demand come back, but nobody's paying attention to them. Brought up lots and lots of names. Don't want to give too much away. A lot of these names are up a ton for us. And I'm very, very happy because we saw small caps not perform well in 2022. You're going to have that period. It's like cryptos didn't perform well in 2022, but late 2020 to 2021, holy cow, massive gains. So there's times where it's pedal to the metal, and there's times we got to say, even though, the economy is on shaky ground, I can provide tons of stats to say, holy shit, you should be worried, and you should be. When it comes to small caps, it's still tremendously off their highs, well off their highs. More than 20% off their November highs, where the S&P is what? Closing about 5% of its all-time highs? But it's a forgotten area of the market that needs to play catch-up to the large cap tech names that have skyrocketed this year. And speaking of large caps, still on a large cap front, Netflix going to report, see what happens. So strong results from Morgan Stanley. Surprised to give their top economists and telling their clients that the market's going to crash since January. But they've done well. Good for them. And Goldman Sachs reported results not so great, which is surprising. And I didn't plan on doing this, but I'm going to share a couple of screens today, and hopefully you could take a look at this, because I'm going to bring this up right now on the fly. So give me a second, this way I could share the screen. I want to show you what's going on with earnings. Right now, we're in the heart of earnings season, next 2-3 weeks. And I want to bring up a site that I have, briefing.com. I don't get paid by these guys, but it's an awesome site if you want. I think it's like $700, $800 for the year. It's like a Cliff Notes version you can have on your phone as well. It gives you all updates on everything and helps you find lots of ideas. Just constant market updates, like to the minute. Companies, goes over the conference calls, gives you earnings calendars. And I'm logging into it now, and I want you to see this earnings result calendar here. Let me share it. I'm going to try to make it a little bit bigger. Okay, if you could see this on YouTube, definitely, give it a shout. Because it's worth it. I'm going to explain it to everyone who doesn't, because a lot of people listen through iTunes. So this is this week. I'm going to click, and it's going to have all the companies that are reporting this week, and they have their expectations. And they have like consensus here. So this is a consensus. And let me go back over here so you could see my cursor. Okay, cool. All right. So now they have, consensus, and then from 1 year ago. If you look at these earnings, like 1 year ago, okay, Bank of America, good job. So, and I'm just doing this on the fly, but I just saw this recently. If you look at like Charles Schwab is higher today. It was higher today. They reported good earnings. People loved it. A year ago, they reported 97 cents for the quarter. This quarter, they reported 71 cents. And I think they came in a little bit ahead of that. But think about that. Think how much earnings are down from last year's quarter for Charles Schwab. And it's going higher. Lockheed Martin, pretty much easy. Morgan Stanley, they celebrated those results. So Morgan Stanley, right, they reported $1.24. And they were expected $1.20. So $1.24, they beat the estimates. Last year, they reported $1.44 this quarter. Something you don't really see these earnings come down the way they are and stocks trade to all-time highs the way they are. And now that we're celebrating because they beat this revised estimate of $1.20, Morgan Stanley. They came in at $1.24 when last year was $1.44. That's how important it is to understand the expectations of stocks going into the quarter. Because you're going to see that they beat, but when you compare them to last year, you're looking at multiples going higher and higher because the earnings are going lower while the stock price is going higher. That means they're getting much, much more expensive. I feel like nobody's talking about that. And Microsoft, great job, AI, more money in their subscription for Office and putting into Bing and everything. I get it. But they're trading at 35 times forward earnings. Forward earnings. I mean, I don't remember Microsoft trading at that level since probably .com, maybe. I mean, taking out 2020 where everything was all crazy and also 2010 credit crisis, but in a normal market condition, not saying this is normal, that's how expensive it is. But when you look through these things, you have great results from American Airlines, right? They're growing. That's fine. That's a good business. They're growing, and that stock should be doing well. But when I look at these, look at JP Transport. I think it's actually, I saw that was up today, $2.42 last comparable quarter. They're expecting $1.90. They came in at $1.81. Even at $1.81, look how much lower that is. So you have to factor that in and look at these stocks and be like, wow, this stock must have really got hammered. I mean, you're looking at earnings down, 20% plus from last year. But yet you'll look at the stock and be like, wow, this shit's trading at near its all-time high. Why is that? That's why I'm saying it's a very dangerous market. Where stocks can go higher, don't fight the trend, the momentum. It's going higher and higher. Again, I've been wrong. We've been fully invested in a lot of stocks, trying to protect ourselves, buying puts. Our portfolio's doing fine, but you still have to be careful. It's a dangerous market. But just going through Activision Blizzard. So this is Wednesdays before the open. Companies reported. Let's go to Baker Hughes. Last year, 11 cents. This year, 33 cents. And they put in 39 cents. That's a great number. I mean, Baker Hughes, if I look at that stock, that's a stock should be trading near its all-time highs, but it's probably not. Right? Because it's oil and it's gotten hit. Goldman Sachs, last year, $7.73. Last year, $7.73 are reported. They were supposed to come in at $3.16. They reported today at $3.08. Okay, so you're looking at more than a 50% cut. So a 50% cut, and let's throw that into, I'll just pull up a CNBC chart. Getting some extra value here for you guys. Let's see what Goldman Sachs is. So from last year, so let's take a year chart, right? Goldman Sachs, earnings down 50%. So this name should be down significantly over the past year, right? And it's not. It was almost under 300. Now it's 340. So it's up 10, 12%, even though earnings are down 50% year over year from that comparable quarter. That's what we're seeing in this market, where earnings are declining, but stock prices are going higher. That's a recipe for disaster eventually. Okay, guys, eventually that is going to happen. But just looking at that, it's pretty crazy when you see results like that. You're looking at not everything is doing great, right? Telecom, media taking on a chin, bad news all around, workers strike, writers strike, workers, fewer people going to the movies, which is, it looks like a secular declining industry now. It just, has nothing to do with COVID or whatever. But people are not going to movies as much. I mean, they don't have time. Maybe they can get a lot of this stuff a couple of weeks later. Just wait for it. Wait for Mission Impossible to come out 2 weeks from now on your streaming platform and pay for it. Decline in streaming revenue and ad sales. And now you have AT&T and Verizon. Again, a Wall Street Journal article highlighting, that cable's covered in lead and it's toxic, and some of them are underwater and all this stuff. And AT&T and Verizon are down 15% this month. Even worse, Frontier. So it's not limited to just those two. Frontier's down 34%. Again, in July. Lumen down 20%. Consolidated Communications down 21%. AT&T and Verizon rebound a little bit since, they're starting to look into a Wall Street Journal article. I know there's a hack job basically done by political organizations, which we're starting to learn now. But still, it's going to create an overhang on them and see. With an industry that was basically slowing down, but the multiples are so low, they are growing earnings and sales pretty much faster than the overall market, and these are names that have gotten annihilated. Why? Because it's risk on. Nobody cares about quality names right now. They're excited. They want to get 1,000% Carvanas. You can't blame them. Even cell tower stocks have been caught up in this. American Tower, SBA, Crown Castle down about 5% each this month. The dollar is crashing. Have you seen that? So the dollar crashing, it's a big deal. Something that we said that was going to happen. I think it's Druckenmiller just came out and said that's his biggest trade like a month and a half ago. Good job. But it's crashing. What does that mean? It's good for gold, good for large cap tech, usually. Staples, industrials, oil services, companies who export products overseas, which is many of the S&P 500 companies. But commodities, this should be a boom for commodities, right? One of the biggest beneficiaries of a weak dollar. And it's funny because while it should be a massive beneficiary, this sector is now more undervalued compared to the Dow Jones Industrial. So when you compare it to the DJIA, Dow Jones Industrial Average, it's more undervalued. And I'm bringing this chart up again, special for YouTube for you guys. More undervalued than any time since, you want to take a guess? Because you're going to be wrong. Since 1900. I'm not kidding. You got to see this chart. It's unbelievable. I posted this again. At Frank Curzio if you want to go on Twitter and take a look at it. Some of the things I say like, holy shit. But they're more undervalued today than 1900. I mean, 1960s, it looks like it's a little bit below that level, but holy cow. I mean, not even close when you go back to 1980, 1970, but all the way back, that's pretty crazy. Okay, here's that chart if you want to take a look at it. Commodities versus Dow Jones Industrial Average. Again, you can watch that on YouTube. I'm going to be explaining everything to you guys so you guys know. For those of you who are not watching this on YouTube and don't want to watch my ugly face on YouTube. But commodities in general make a lot of sense. Probably a good time to go bottom fishing if you have a 24-month longer time frame. You don't want to try to catch a falling knife, and that's what you've been doing basically for the past almost since 2012 outside of a few highlighted areas. But junior miners, gold, silver, even uranium stocks, these names are trading well off their highs, even though silver prices have been pretty strong. Copper prices have held up pretty well. Gold trading near its all-time high. I know what you're thinking. You're like, Frank, did you just say 24 months? Are you out of your mind? And I get it. I mean, everything is so real time. Everything that's happening. I get judged on a stock. I mean, Daniel recommended a stock in our Dollar Stock Club portfolio, and it had some good news, and it popped. And I was like, wow, good job. He's like, well, we'll see. I was like, no, everyone's going to say that was a great pick, regardless of what happens 3 months from now, because that's the nature of the world. Not even of our business, but of the world, right? You say 24 months, investors are like, Frank, what do you want? It's like holding for 40 years. But the reason why I said this, or I'm saying this, is because this is where I made a shitload of money. So pay attention. I bought into several private placements when these names got hammered in 15, 16, even some in 2014, and they came along with what? They had to offer 5-year warrants because the industry's terrible, meaning that they need to offer a sweetener. This way you take it. And warrants are a great thing, right? So you get free warrants, basically, and they're exercisable, usually 30% on average, maybe higher than where the stock is trading. So if the stock really takes off, you exercise them. So just say if the stock's at 10 and they exercise at 13, If the stock goes to 20, you exercise at 13, you sell them at 20. And that's not, I'm not even talking about your position, right? So you still have the shares. This is like free money to you. This is how you make a fortune in this industry. Now, it hasn't worked because the industry has been under lots of pressure. It's terrible. And even when you saw negative real interest rates and inflation go higher, which should be good for gold stocks, however, their costs they rose significantly to do business. Massive. So it hurt them as well. But investing these early, we saw a big spike in commodities, in gold and silver stocks. And in 2017, I'm like, oh shit, I have some of these. I just bought them and held them. Investing, across, not going all in on these things, investing here. 4 or 5 of them. And I was able to exercise the warrants and again, bought these names, forgot about them, and probably made 3x to 5x on some of these in 4 years. Amazing gains. In 4 years. Again, people don't pay attention. 4 years. Wow, 4 years is too long. It's not that long. Especially when you're seeing where commodities are. In Curzio Venture, if you're a credit investor, you're going to get introduced to some private placements in the mining sector going forward. First started this newsletter, you saw some come into the portfolio. But now there's a lot of names that I like. And I don't get paid from these companies. We're independent. But these are names I'm investing in personally. I can tell you how much I'm going to put into these things. And then you call the company and do what you want to do. So I just give you access or provide the handshake, and then you do what you got to do. That's part of Curzio Venture Opportunities. You're not going to see them in the portfolio of us tracking them because not everyone can get in at the same price if you're not a credit investor. You don't have to be in a credit investor to get into Curzio Venture. Again, we haven't gotten to anything in 18 months. There might be one here or another there if you're a credit investor. That's something we offer in that newsletter. Largely stayed away from this industry when it comes to private placements because it was terrible. It was horrible. But right now, if you're looking at where these stocks are trading and where the underlying commodities trading, it's a huge disconnect. Huge. Now you have a weaker dollar. You have central banks buying gold at the fastest pace in a half a century. It's a good time to allocate a little bit of money into these names. And when I say into these names, I'm saying at the junior miners sector as a whole, I would say maybe 7%. 7% of that sector. I say 90% of cryptos are shit. I would say 93% of junior miners are shit. They're structured terribly. Which is why so many, if you look right now, are still trading, 50% off their all-time highs, despite the underlying commodity like gold trading near its all-time high. When do you see that? When oil and natural gas surge, you see stocks who are focused on oil and natural gas surge alongside. Sometimes they might not go as high, but you're going to see them move. You're not going to see oil hit an all-time high and oil stocks that drove for oil be down 50%. You'll never see that. You see that in gold because they're structured so terribly where they just dilute the shit out of you forever, then issue massive amount of warrants. But think about all of you out there, which is a lot of you that I met. You've been going to mining conferences for over a decade. I've seen you there. I talked to a lot of you, and a lot of you listen to this podcast. I want to ask you a question. How many stocks have you made money on that you didn't get into a private placement in the mining industry, that you're holding on today, that you're up on, that you bought maybe since 2000? Let's go 10 years. 10 years. So 2012 was the bull market, and then it started crashing. But how many things over the past 10 years you've been pitched? Uranium, copper, all this shit, mining, silver. How many names have you made money on in this sector? And a lot of you allocate a lot of money to this sector. With me, I follow all sectors. There's times to invest in this and times not to. There's times to invest in crypto, there's times not to. Right now, it's a great time to invest in small caps. Right now, it's probably a great time to invest in commodities. It wasn't for a while. Now you have a lot of these tailwinds. You're seeing a sector that's totally out of favor that everyone hates. You need to reallocate money from technology because it's so over-owned. I don't think you could own any more of it. And you're seeing that go into other areas where other areas are starting to build up in the marketplace. But commodities, wow. I'll tell you what, in tomorrow's Wall Street Unplugged Premium, Daniel and I are going to share a few names, junior miners. Not just any names. Names that have strong management teams, great balance sheets, great projects with high-grade gold and silver that can actually become a producing mine one day. One that has infrastructure in place. I feel like that's ignored. Infrastructure, what do you mean? Access to water, having roads, being able to deliver it. having buildings, having man camps set up, whatever you need to set up. You know how much that costs? And people don't tell you that because you can find a $5 billion gold deposit in the middle of Antarctica. They're not going to tell you it's going to cost $10 billion to get it out, which makes that project totally worthless, which is probably a lot of projects that you might have invested in over the last 10 years. They don't tell you that. Infrastructure is huge. When it's near in mine and everything's in place, it makes it a lot easier. It lowers the cost significantly for miners who are not generating any revenue. They need to lower their costs. So I had a great interview that presented to Curzio Venture subscribers and also Wall Street Unplugged Premium members with U.S. Gold. It's CO on here, and it wasn't this rah-rah cheer story. It's like, this is how we de-risk the project. This is how we've lowered costs significantly because we believe copper's a big deal. We could sell a lot of the rock and everything to Martin Marietta, who's right not too far away, and that's going to bring in money for just ways to de-risk the project as the market gets better. That's what these good management teams should be doing. But also names where their signature projects are in mine-friendly jurisdictions. Maybe one of those names make their way into the DSC portfolio, which DSC stands for Dollar Stock Club, and that's free for all Wall Street Unplugged Premium members. Daily, I recommend one trading idea every single week. My portfolio has been doing well the past couple of weeks and months, right? I've seen the market come back. And, we try to provide some aggressive ideas in it. There are some industry leaders as well, but we think have huge upside over the next few months against a trading newsletter. And it's a really cool newsletter. Daniel handles that. We go over the ideas in that podcast, and he does actually every 2 weeks, he does a video portfolio update, which is better than me doing it because he's a lot better looking than me. But getting back to small caps real quick. Even today, since if you look at the major indices, NASDAQ, S&P are still wildly outperforming small caps. Small caps are significantly undervalued compared to large caps. And how much so? And please, if you get a chance, try to look at this chart on our YouTube channel. It's a relative forward PE for U.S. small versus large caps. And this chart is unbelievable. Okay? You're looking at it, small caps right now are more undervalued to large caps than any other time since 2000. And it's not even close. It's not even close. Usually you see when the market's like this, NASDAQ goes higher, small caps, aggressive market, they go higher. But nobody gives a shit about small caps. And these are names that understood, just like you did with your business and everyone understood in the past 12 months, hey, a recession's coming, need to dial back. They've done that. But they haven't gone up like large caps, especially tech. But you're looking at the last time they were this undervalued, it was 2000. Before that, the last time it was this undervalued, and it wasn't even that undervalued. The last comparable period, 1979. That's a big disconnect, guys. It's why some of these stocks that we're recommending, we're scaling into, and some of them have gone up 100% in a month and a half, 2 months. Right? 2 names at least. Rivian's another one of those names that we talked about. And I don't want to give away too many of those names, but wow, this is what we're seeing. We're seeing, and it's not like, hey, we're geniuses or anything. No, it has nothing to do with that. It's these companies reported earnings 3 months ago and basically came out and said, all the shit that pushed our stock down 30, 40%, we've addressed, cut our costs, focus on the sectors that are doing well, the segments that are doing well. And now they're well positioned where you see in some pockets of demand in certain areas. And that's where we're looking at these companies. But now their balance sheets are strong. They're buying back a shitload of their stock as a percentage of float, much more than Apple is a percentage of a float or Google. And these guys are buying back 10% plus of their float. Apple's buying back, 3% of its float? And that's a massive amount. And also insiders are starting to participate in that. So for some of that comes to small caps my whole entire life. Again, for Kramer and stocks under 10, and then another newsletter for Stansberry. This is what I've done for pretty much 30 years. It's pretty cool right now seeing great companies and companies that I'm looking at going, wow, this thing's probably trading near its 52-week high. And I look and it's down 25% from its high. I'm like, holy shit. A lot of great names. So that's an area that's awesome. Big disconnects I'm still seeing. And again, it hasn't been this big of a disconnect since 2000 and a time before that, 1979. That chart's amazing. So a lot of you have taken me up on the 80% discounted offer where you can buy any of our 3 premium products, which is Money Flow Trader, Crypto Intelligence, Curzio Venture for $1,000 for the year for an annual subscription. Right, those are usually $5,000 products. Many of you have taken Curzio Venture, which is cool, and that subscription included a 10-minute call with me. So that call is absolutely awesome. I say it that I look forward to that call, to those calls. because, they're set up over the next few weeks. And it should be, I think, because everyone's happy to talk to me and they're like, oh, this is so cool, Frank. And new subscribers, it's not like I'm talking to a subscriber that has 4 losers and Frank, what the fuck? It's cool. But it's nice to talk to everyone. And it's important because one is we have slots left. If you're still interested, we're going to pull that offer offline this week, that 10-minute call. But more importantly is when it comes to the calls and talking to so many of you, and again, people who are in AI and people in the military, people who told me that they own I was talking about Rivian, how amazing it is and how they could scale. And he says he owns a Rivian and a Mach-E, which is the Ford, I think, EV, which is similar to the Mustang. And he said the Rivian's absolutely, he's like, as soon as I bought it, I bought the stock. It's amazing. I mean, just really good information talking to people. But I realized something. It's serious. Some of you have certain newsletters that you need help extracting the most value out of. Some have subscriptions that you may want to switch to something else or something's coming up or whatever. But talking to you personally, it was such a big deal and a positive experience. For the first time in our history for Curzio Research, we're going to have an active support line. Okay, we're going to offer this, and we're offering this. We're growing, but actively looking at customer retention. And we have the ability to do that as a small company. Have the ability to really talk to you over the phone and talk to you about your memberships, discuss how, you may be positioned a certain way, or again, we can't give financial advice, but you might have a certain allocation to whatever, and we're like, hey, these newsletters might serve you better, and maybe a subscription is coming up, and we'll say, okay, add it to this or whatever. It's just different things that we could do for you, especially since a lot of you have been clients for me for a long time. And also we have the ability to discuss, most exciting opportunities we have. Like what I said, small caps are really, really exciting. You've never seen me talk about Curzio venture opportunities the way I've talked about over the past 2-3 months. Okay, I'll say, hey, this is a good opportunity. This is great. I mean, I've been pushing it, and I'm pushing it because this is what I'm seeing. This is where I'm putting my own money. But yeah, I want to offer that service. That's more value to you guys. You're going to start getting emails about this in the coming days. Again, it's not anything you need to do. I'm just saying, if you want to call and talk a little bit more about your subscriptions or anything, or things that we could do, because a lot of you have different subscriptions, and I want to make sure, you're using the right way. We try to explain that in, our newsletters and behind the paywall and stuff like that. But again, not everyone has a lot of time to see everything that we produce and everything we do. And that call was essential where, there's people that have been with me for a very, very long time, and they're like, well, I really would like it. And I was able to provide them a discount, even bigger discount, because they paid $10,000 over 4 or 5 years in subscriptions. And I'm like, okay, that's something that, we're able to do through the support line. Which is cool. Again, it's really about the customers and treating them well. And by talking, we know, and again, talking to so many of you through this offer, it ensures that, one, that we're there for you, but also from your point of view, it's, hey, how many people in our industry could you do that for? Like, how many newsletters you subscribe to that you're seeing that where you're able to talk to the person who has a name on the door? But through the customer support, again, we're going to have a couple people that we train that are great, that are going to be able to talk to you about the products and offerings and things like that, and just, be able to help you. Can you get emails on how to contact them if you want? They're not going to call you blindly or whatever. You just say, hey, you know what? I'd like to speak to someone. Arrange a call with them, and it's really, really cool. And that's, again, an added value of our service and a feature that we want to separate ourselves from everyone else in the industry. So expect a couple of emails. Take advantage of it if you're a paid subscriber, because, again, there's a lot of you now. A lot of people come in. We try to treat everybody the same, but sometimes we'll have someone that the subscriber for, since the Kramer days, and maybe wants a product or something, and there's things that we could do, or maybe there's things that we could switch around for you guys, and it helps tremendously. And I tell you, after every one of those calls, when people get off, they're really thankful, they feel comfortable, they trust you a lot more, and that's what we want. That's what we want to do for Curzio Research. So you'll see that in the coming days. Again, that's not sales or anything. That's just to help you guys out, so added value, and hopefully you guys appreciate it. So that's it for me. Questions, comments, for the email at frankcurzioresearch.com for Wall Street Unplugged Premium members. I will see you tomorrow with the one and only Daniel Creech. See you then. Be careful with these markets. Pretty crazy, but enjoy the run-up. And again, we're going to come with some mining stocks tomorrow, junior miners, that look promising, given that commodities are more undervalued than any time since 1900. Are you kidding me? Are you absolutely insane? Not to mention that now with the weaker dollar, these stocks have the ability to go up hundreds and hundreds of percent. That's what happens. That's why people invest in junior miners, because they want to catch the cycle. You're close to the cycle. Might not happen in 3 months, might not happen in 6 months, might not happen in 9 months. But right now, at the prices you're able to get some of these in the good names, going to share something with you tomorrow. You have a huge opportunity because now you have all these tailwinds in your favor finally. So we'll go over those names tomorrow. We'll show up a premium. I'll see you then. Take care.